Well, you would be pretty hard pressed to find an industry that has a bigger impact on people's day-to-day lives, whether they realize it or not, than boring old banking. Banks play a key role in helping people to exchange goods and services on a day-to-day basis, and they also play a key role in matching people that have money with people that need to borrow money, whether they want to purchase a particular asset, whether that be a house or a car, or whether they need capital to start some sort of new business venture. Banks can be great businesses, and investors like Warren Buffett have invested very successfully in banks over a long period of time. Yet a lot of people don't spend a huge amount of time considering banks as investments that they can make in the stock market, and they don't consider putting banks into their portfolio. There are countless reasons why people do this. They're viewed as complicated, hard to understand, boring, slow growing, or maybe even flat out risky. And for a long time, I have had the exact same view on investing in banks, that they are far too complicated for me to get my head around. And when I look at the 13F filings of investors like Warren Buffett and Berkshire Hathaway, for example, I like to pay lots of attention to their investments in things like Apple or HP or Coca-Cola, but myself and many others tend to skip over huge investments like Bank of America, which is the second largest investment in Warren Buffett's entire stock portfolio. And after recently coming across a bank stock that has really piqued my interest due to their phenomenal financial results, I've really recently got the motivation to try and better understand banks. And I picked up this book recently, The Bank Investor's Handbook. I haven't finished all of it yet, but it has been a really good way for me to get started in trying to understand banks as businesses, how they work, how to value them, and whether I potentially want to make my very first investment in a bank stock. So in this video, I want to start from the beginning and go through some of the very basics of the banking business model. How do banks actually make money by taking in deposits from individuals and lending it out to others? How does that work? How does leverage play into the picture? What are the key risks and some of the things that I would look for when starting to analyze a bank stock investment? Now, if you've been investing in bank stocks for a long time, this might be a little bit of revision, or it might be far too simple for you. But this is the type of video that I personally would have liked to see when I was first getting started in investing, because I think it would have made investing in banking businesses a far less scary proposition than I used to think it was. So if you enjoyed this video, be sure to hit like and also subscribe to the channel if you are new here, and let me know down in the comments below if you enjoy this type of content and whether you'd like to see a part 2 video on how to analyze banks as investments. Now, firstly, banks often do have a reputation for being very complicated businesses, and I think that's because in most cases when people think of investing in bank stocks, they think of the likes of Bank of America or JP Morgan or Wells Fargo, or these huge banks that have many different aspects to their business. They don't just have a core bank business where they take in deposits and make loans. They might have several types of loans they make. They might have a credit card business. They might have an investment banking arm, and it can all get very complicated to understand. But there are actually a very, very large number of smaller regional banks that are listed on US stock exchanges. And many of these banks will actually specialize in doing maybe only one or two things. They might only loan to commercial real estate developers, for example, and maybe they don't even have a lot of these standard kind of consumer-facing products like credit cards. And like Nathan Tobick talks about in the Bank Investor's Handbook, I think the key component to understand is the core banking business. And when you analyze a stock that has some of these other aspects, they're kind of areas that you're going to need to bolt on to your analysis outside of the core deposit and lending arm of the bank. Okay, so let's say that hypothetically I wanted to go out and start my own bank. Let's call it Investing with Tom Banking, and let's say that I wanted to start up this very small bank with $100,000 in capital. We're not going to be competing with the likes of JP Morgan and so on initially, but we're going to take our $100,000 and I'm going to start a bank, and I'm going to start advertising so that I can take in deposits, and once I've got a reasonable number of deposits, I'm going to take that money and then I'm going to loan it out to people who need that capital. And Nathan Tobick uses a very kind of similar story to the one I'm about to lay out in the Bank Investor's Handbook. So if Nathan Oddball Stocks on Twitter, I believe, happens to be watching this, your book is great, and thank you. And I've modified your example here somewhat. So let's say I've got my $100,000 and I'm going out and starting my bank. Now, the first thing to keep in mind is that banks are very highly regulated, and those regulations can change from state to state and certainly from country to country. So let's say, just for argument's sake, that the Investing with Tom Bank has to keep about 10% of its capital in cash. Now, the reason that we have to do this is basically if I were to get a whole bunch of deposits and then some people wanted their money back, I have to have kind of the cash available to pay those people back. I can't loan out every single dollar. I have to have something available for if people kind of pull their money out of the bank in the short term. So let's say that for the Investing with Tom Bank, I need at least 10% of my capital basically in cash should anyone want to withdraw their deposits. Now that means that I can take in up to $1 million in deposits from people who want to join my bank and set up an account, as long as I keep that $100,000 available should some of that money need to be withdrawn by depositors. Now I'm going to be reasonably stingy here, and I'm only going to pay the people that are depositing money with the Investing with Tom Bank a 1% interest rate, and then I'm going to take that money and find people who need loans, and I'm going to lend that money out to them at a 5% interest rate. So you can now see I'm starting to capture the spread between the 1% that I'm paying on $1 million to the people who have deposits, and I'm earning 5% on that money from the people who have borrowed from me. So this is what a very simple balance sheet might look like for the Investing with Tom Bank once I've got my $1 million in deposits, and also I've gone and kind of lent that $1 million back out to people who want to borrow that money. So I have my $100,000 in cash that I'm keeping because the regulators want me to keep it there just in case any depositors should want their money back. I've got $1 million of loans. Now for a bank, a loan is going to be an asset. It's sort of the inverse of what you'd see at a typical company. Earning my 5% return on those loans, assuming that people pay their loans and don't default on them. And I also have a $1 million liability, which is the cash that came in when people made their deposits. Now that of course gives me equity of $100,000. My $1 million of loans and $1 million of deposits offset each other, but I have $100,000 in cash, so I have $100,000 in equity, and the total liabilities plus shareholders' equity is $1.1 million. Let's now jump over to the income statement for this bank and see how I'm actually turning some of these assets and liabilities into profits for the Investing with Tom Bank. Now, the first item is going to be interest income from the $1 million in loans that I've made. Like I said, I'm loaning that money out at 5%, and let's just assume for this example, to keep it simple, that everyone has paid their 5% interest. No one's kind of missing payments or anything, so that gives me $50,000 of interest income. Now, also have to remember that I'm paying the depositors a 1% interest rate on the money that they've kind of left in the Investing with Tom Bank, so that is a $10,000 interest expense. I have $0 in loan losses, which is great. Everyone is paying me back as required, and that gives me net interest income of $40,000. Now, of course, the bank is going to have some expenses. Maybe I want to open a branch. Maybe I need to pay some people's salaries. Luckily, the Investing with Tom Bank runs extremely lean, and my operating expenses are only $15,000. So I have $40,000 in net interest income. I've spent $15,000 to run the operations of the business, which leaves me $25,000 in pre-tax profit, which, after I pay a tax rate of 21%, leaves me with net income of $19,750. Now, if we look at some very basic metrics in terms of how the bank has performed, two that I really like to look at are the return on assets and the return on equity, just like I would basically look at for almost any other type of business. Now, the nature of banking means that there is just inherently a lot of leverage, and there's going to be quite a big differential between return on assets and return on equity. So the return on assets in this case, I've made a net income of $19,750 on assets of $1.1 million, which gives me a return on assets of a paltry 1.8%, which actually by banking standards is very good. I will put up some metrics here for the likes of Bank of America and JP Morgan and so on, so that you can see where they sit. Now, my bank is of course very leveraged, and I don't have that full 1.1 million as equity. I actually only have $100,000 in equity. So my return on equity is 19,750 divided by 100,000, which gives me a 19.8% return on equity, which is very healthy by almost anyone's standard. And that fundamentally is how a bank works. Now, of course, I have to make a decision about what I do with those profits. Do I retain that as new capital in the business, which would allow me to take new deposits and make new loans and still keep within that 10% kind of threshold from my regulators? Or I could maybe pay that out as a dividend, or, pay myself a larger salary as the CEO next year, whatever you want to do. Now, of course, there are many risks that we need to talk about when it comes to the basic business model of banking. Now, the number one risk, and the one that luckily the Investing with Tom Bank did not experience at all, is basically making bad loans. And banking, like I said, is inherently a very leveraged business model, so you don't actually need to make very many bad loans for your entire profitability to be wiped out. You might recall that the pre-tax profits of the Investing with Tom Bank was $25,000, but we had loans of about $1 million out. Now, if we had 25,000 of that $1 million of loans go bad and we never got that money back again, my entire pre-tax profitability would be wiped out. So that's only 2.5% of my loans. If those were to go bad, I'm really not going to make any money. And if I have more than 2.5% of the loans go bad, that can create a very, very bad situation for my bank. So that really is pretty much the number one risk when it comes to the core business of banking. And of course, the more leveraged you are, the kind of closer I am to that 10% minimum capital that I need to have available, the kind of smaller the percentage of loans that need to go bad before you run into issues. And my bank is quite leveraged. It's leveraged assets to equity about 11 to 1, which again actually isn't too out of the ordinary for many banking businesses. Bank of America is leveraged about 9 to 1, and JP Morgan is about 10.7 to 1. So we're slightly more leveraged than JP Morgan, but nothing too crazy. And the fact that we had 0 loan losses means I'm writing very, very safe loans, and that potentially means that if I can continue to write very, very safe loans, possibly the bank could handle more leverage. If I was writing much riskier loans, which have a lot of them tending to default or become non-performing loans, potentially I would want to run the bank with a whole lot less leverage. And of course, another big risk is basically having very flaky depositors. Now, $1 million is not a lot of money to have in a bank, and particularly if it was concentrated in a very small number of people and they wanted to pull their money out very quickly, again, we would have some significant issues. I only have $100,000 available. If $500,000 wants to get pulled out of my bank, we're going to run into some troubles, and that is what you may have heard of referred to as a run on a bank. Basically, when people get scared that a bank is going to run into troubles and they're not going to be able to get their money back, they go to the bank, and Warren Buffett actually talked about this in a recent shareholder meeting, where the banker tries to give the money back as slowly as they possibly can in order to, avoid bankruptcy, basically. So that is a very basic overview of how the core business model of banking works, some of the leverage involved, some of the potential risks, but also the potential rewards. When you can have very disciplined underwriting of loans, we don't have a lot of loans go south, and you can earn pretty good returns on equity. Warren Buffett has said several times that banking is a really good business if you avoid basically doing stupid things. And banks are very easy businesses to grow. You can advertise that depositors can earn higher rates of interest than the bank across the street. That'll bring lots of money in. You can advertise for cheaper rates of interest on loans than the guy across the street. That'll bring in lots of people that want to borrow money from you, but those things aren't necessarily healthy growth, and it can bring a lot of risk into the picture of having very unprofitable growth. And again, you can over leverage yourself and run into issues with non-performing loans and that sort of thing too. So that's all I've got for this one. My kind of dive into the banking world and trying to understand this stuff has been actually pretty fun so far. So I do hope you enjoyed this one. If you want a part 2, definitely let me know down in the comments below. But that's it from me for this video, and I'll see you in the next one. Cheers.